All right, folks, we need to spend a little bit of time today just having a look at an important concept on just implied volatility. Whether you use options in your trading and investing or you don't, this is a really important concept to understand. And this, I'm going to show an example here of a chart of a GameStop, just because it's an example that here very much is in the news right now when it has extreme implied volatility. So I wanted to quickly show you how important it is to pay attention to something called implied volatility, which is a big part of options pricing. So let's have a quick look at this chart. And this is GameStop, the stock, and you can see at the top this bit here is the price chart. Massive rally. Stock went from like whatever, $20 to almost $500. Insanity. But I think one of the bits that a lot of folks kind of missed, just having a look at some of the message boards and things like that when they were calling to for buying puts, is that the price of options has gone completely nuts. So when the stock was trading around $15, implied volatility was closer to, it was already high, but it was like 120%, very high actually. But it went as high as like 560+%, which is it's like a different stratosphere. But what happens if you buy a put up here and you think the stock's going to go down and you think you're going to profit from it? That's probably not going to happen. Why? Because it is quite likely that even though the stock could drop very quickly, the level of implied volatility could potentially, arguably, drop even more. Meaning that even though the stock might be going down, the put options are gonna lose value dramatically because the implied volatility goes down. On sort of a similar example would have been on the upside. You could have bought, let's say, call options. In this case, the implied volatility went higher all the time throughout the rally. But there's a lot of examples where you'll find where a stock goes higher, but implied volatility actually stops going higher, and then you end up buying very expensive calls. So the point is, and that we can go into all sorts of different details on this, but I think the important thing here is to make sure that you pay some attention to implied volatility. This is an extreme example, but I wanted to show you this because it's visually very clear. And B, also, I think everyone's kind of familiar with the situation or the stock rally. So if you think GameStop's going to go down right now, this is not advice in any way. It's just as hypothetical, and you want to buy a put, you need to be very careful with that. There are other ways of doing it. You could use call options and sell them, or called bear call spreads, where you make a less directional bet, or where at least you're a net seller of options, which is better if you imply volatility is very high. It's a topic for another time, but just thought I would quickly mention that. So hope it's helpful, and see you guys soon.